Hello and a very warm welcome to everyone. It seems that the tech industry had weathered COVID-19 disruption to be accelerated into the future, pushing for digital transformation at a much quicker rate. Yet, in 2022, technology stocks fell more than 30%, and technology firms were embracing mass layoffs at much higher rates since then. So, in this era of what Satya Nadella calls the golden age of artificial intelligence, can the technology landscape, where the economic slowdown, and still remain innovative and sustainable? With rising interest rates and inflation levels, what does India's M&A activity look like? And at the same time, can the tech sector be prepared for evolving regulation in India? To explore this all, we welcome Mehak Khanna of Khaitan and Pratip Mazumdar. Mehak, first question really, and straight jumping into the conversation. Give me a sense, give me an on-the-ground sense of what really is happening on the fundraising ground. I do know a lot of narratives have been painted. Fundraising winter, perhaps the worst that we have seen till now. But what do you really think is happening on the fundraising ground from both the perspectives? One, from the startup perspective, and secondly, for the fund managers who are on the fundraising prowl with the LPs. Yes.
Sure. Hi, Shija. Hi, Prateep. Good to be connected and great to be having this conversation. And just diving straight into the question as to what is it that we are seeing on the ground as far as the deal making is concerned on the tech side. Of course, I mean, if we look at the numbers in 2023. There has been a bit of stagnation. There have been lesser number of deals compared to the number of deals that happened in 2022. However, if we look at various sectors, especially education tech, which is your edutech, and if we look at the gaming sector, they've in fact raised enough funds, and there's been an increase as far as the funding is concerned in these two sectors. And if we look at the fintech sector, that has of course seen a decline. And overall, the sentiment, of course, still is bullish as far as the tech sector is concerned, and the funds and the investors are looking to invest in this sector. So overall, I believe that there is confidence. Of course, in terms of the numbers, we'll have to see where we land towards the end of 2023. The numbers are less compared to 2022, but there are a few subsectors that are doing well, and especially on the gaming and edutech side, and yes, a bit of e-commerce as well.
Prateep, I would like to come to you now. Mehak suggested that while the deal volumes and data could reflect that the numbers have come down, perhaps at best it's a temporary blip, because she suggested that the confidence remains strong and there's some pockets which are actually seeing more traction, like edutech and gaming. From a VC perspective, the capital allocators perspective, give us what's going in the minds of the VC industry. Is it a temporary blip at the best, or do you really think that this funding winter is going to really sustain for a longer time?
So first of all, Shrija, thanks for having me on the show. Good afternoon to everyone. Mehak, hello. So I'm Pratip. I represent Inflexor Ventures. I'm one of the partners at the firm. We are a C2 Series B early stage fund, horizontally focused on enterprise software and deep tech. That's the space in which we operate. To your query, so first let me reiterate, is there a funding winter? The one word answer for it is no, right? But has there been a drop in deal traction, deal volume, capital being raised? The answer is yes, unequivocally yes. Will it remain subdued in the near term? My view is yes, at least for the next, I would say, 4 to 8 quarters, right? The environment and the markets will be challenging, both from a fundraise perspective as well as from a deployment perspective. There are headwinds. They will continue to be there. Having said this, the reason why I think there's no funding winter. It's essentially because there's a lot of dry capital waiting on the sidelines to be deployed. And for sure, good companies which have proven to the investors great product market fit and haven't burned a lot of money in the last few years and have been sensible in raising capital at the right valuation will always attract capital. And that we have seen even post the dot-com burst, post the the great the great recession and or the global financial crisis of 2008, and even post 2014 as well, right? So good companies at all points of time will be able to attract capital, and there is enough and more capital already available in the market today. So that's at a very broad macro level the opening thoughts that I would like to
Thanks
share.
for that, Pratip. So basically, Mehak, there is enough dry powder just waiting on the sidelines to be deployed. But of course, the data seems to be suggesting that if we compare just to the previous calendar year, there seems to be a reasonable decline in terms of the deal volume, and of course, the number of deals that similarly just have happened. But there seems to be a certain kind of renaissance, if you will, or a second birth with the advent of generative artificial intelligence. That seems to have changed the ballgame altogether. There's so much excitement with AI. What is the sense that you are getting? Do you think that this is another new bandwagon which investors are latching onto? We have seen these waves in the past also. There was a major e-commerce wave where everybody wanted to invest in e-commerce. And there was a payments wave where all payments company became hot. And I think we've forgotten the metaverse wave. I think VCs have very short memory. We just forgot metaverse. And now there seems to be AI. Do you think it is a more longer term generational kind of shift or trend in terms of VC allocation? Or do you think it will just, again, something just very short term?
Shita, very good question, very interesting one as well. I mean, just looking at the nature of AI, I mean, it's just so dynamic and fast evolving that I believe that it's going to be a short-term wave, because AI is definitely going to transform into something else. The AI of today, as of today, is also something which is very fast evolving. And the way AI is being used by different companies is also going to change. So while we did see, a lot of interest over a longer period of time in e-commerce and in the fintech sector, that's because those sectors do not evolve as dynamically as something like AI does. And AI, of course, I mean, it's too broad, but the way AI is being used in products and the way, the regulations are changing around it, a lot of that is also going to determine the interest of the investors. So to my mind, the AI that we see in the current form, I see that undergoing a transformation as we move along and as the government starts regulating it. I mean, to take an example of Government of India, there is a national level strategy of dealing with AI. The think tanks, especially Niti Aayog, are working on guidelines. They already have a current set of guidelines. They're working on improvising those guidelines on AI. The MIT, which is the Ministry of Information and Technology, they'd set up committees to look into AI. Those committees gave their reports last year. And there are a lot of suggestions on how to regulate AI, how to bring in more transparency, how to look at privacy, security, safety, how to ensure that AI doesn't cause damage, how to ensure that the entire route of the AI is more transparent. So all of these factors are evolving. They're being considered and reconsidered by the government. And of course, we'll also see at a policy level that, this is going to be getting governed. And that is also going to change the course of the investments coming into the sector, because if it becomes regulation heavy, then of course the investors are going to take a second look at it.
Okay, Pratik, what is your view on this entire AI narrative being built? I do know that you started the conversation saying that you're very focused on two sectors, but AI is all pervasive. Every sector seems to be using artificial intelligence. What are the kind of companies or products or services or ideas that you are seeing? Do you really seeing companies are AI washing, in the sense that even if they don't use AI so much, the way the greenwashing was happening, that I'm a green company just to raise money, a lot of companies are AI washing. What really is your sense?
So obviously, I partially, agree with Mehak and Shreya, your assessment. Right? Per se, is AI here to stay? The answer is yes. Is it a long-term trend? Uh, Answer is yes, unequivocally yes. A lot of sectors over a period of time will get uh, disrupted with the use of AI, machine learning, automation built in. Having said that, one of the subsectors in the recent times which has been attracting a lot of amount of capital both overseas and to an extent in India per se is obviously AI. But at the same time, I agree with Mehak, okay, over a period of time, this sector and space will look very different. Say, couple of, not even a long term, maybe couple of years from now itself.
Yes, yeah.
It will get more democratized, right? In the way it is being used, right? As of now, people are just scratching at the top of the surface. There are multiple use cases which has potential monetization impact. People are yet figuring it out. As of now, Shija, you are right in, in making a statement like greenwashing, people are doing AI washing. Bunch of people, that always happens when a new trend or a theme comes in. Everything was metaverse, right? Everything eventually was fintech. Everything eventually was into building an e-commerce business model, right? Trying to fight Amazon. So that typically happens, but over a period of time, as the space and the sector gets maturity, people understand and appreciate the nuances. Obviously, things change for the better. So for sure, I think it's a long-term trend to stay, right? Yeah, and currently that space or the segment is quite overheated from a investment allocation perspective. So, a lot of people are looking at a land grab kind of approach, right? We are seeing, except the AI sector or the space, no other sectors are raising seed round at say a 15, 20, $30 million valuation, right? Which is unheard for, right? This was happening few years back in the e-commerce space and others, right? So that's where I would like to place my views.
So, what really are you seeing in terms of great or interesting ideas? Suppose within your space only, let's talk about green tech or enterprise, some things which are not so mainstream because you come across being somebody as a firm which has an understanding of technology in a deep way because you back deep tech companies. So, what really are the new ideas or new innovative solutions which you think has completely been put on a very fast track, maybe with or without the use of AI, which are yet to get
No, no,
mainstream and you're putting your hands early on? Yeah.
no. So for sure, the way AI and machine learning and LLMs, large language models, will evolve, um, the use cases uh, in the biotech industry or bioinformatics space, in drug discovery, on the pharma space, in those areas where there is a lot of data processing capabilities on an automated form is required, there AI will make a huge difference in terms of uh, how do you take a product from stage one to stage two in a much more accelerated way, right? How do you use better computing or using different kind of specified AI models to derive results or outcomes which can yield better results, or at least one can conclude, yes, if this is a path to be taken or not. So the use cases in healthcare, biomedical, automation is just massive, right? From an AI perspective. So these are the areas which we for sure see practical applications, right? Models on those fronts are currently being built out. Those kind of deep models currently are not being built out in India, but in the US, there's been a huge thrust and emphasis of it being getting built out.
Okay. Mehak, I want to understand from you. Pratip spoke about the few use cases from an AI perspective. Coming to you from a regulatory perspective, you also said that, Shrija, if the sector were to come under purview of regulation, perhaps the investors' capital allocation or deployment could see a certain change. Mehak, could you hear me?
Uh, I lost a bit of your
Okay.
question. Yeah.
Yeah, so I was understanding about the purview of regulation for AI, because you did mention that if it were to become heavily regulated, the capital allocation or the interest could dramatically change. Is there any global standard which India should look at when it comes to an AI playbook for regulation? Yeah, so I was understanding about the purview of regulation for AI, because you did mention that if it were to become heavily regulated, the capital allocation or the interest could dramatically change. Is there any global standard which India should look at when it comes to an AI playbook for regulation? When you have such fast evolving technology, which is so difficult to fathom at the first place, I mean, how do you regulate an animal like AI? Uh, how does one even think about that? What are the thinking lines for this?
Committees to look into it. And as issues keep cropping up, by the day they'll of course look at incorporating all of those as well, do stakeholders discussions, and then come up with the policy framework, and then probably in future a law as well. And if we look at other jurisdictions, I believe there are jurisdictions where there are laws that regulate AI. I'm not sure, but I think US does have a law around it as well. But having said that, I think that in terms of a particular law for a particular country, especially a country like India, I think that the law would need to be customized to the needs of the startup AI ecosystem here, and the kind of issues that one is going to face here. Also, in terms of the maturity of the sector, considering it's a fairly new sector, and in terms of fairness, ethics, data protection, security, one is at a nascent stage. So all of these things would need to be built up from scratch as far as the regulatory protections are concerned. And while, if we look at developed countries in terms of their data protection, data security, and their tech regulatory setups, they are at least, 2 or 3 decades ahead of us. So I don't think we'll be able to sort of apply those laws as it is here. And we'll have to probably customize something which is better suited for our systems here, and that address the issues here, and that also don't make the sector too regulation heavy, because if that happens, then of course there is going to be some amount of change in sentiment as far as the investors are concerned, because from their standpoint, the sector also needs to be easy to operate. And we've seen with the gaming sector that when too many regulatory changes happen, it of course does disrupt the deal flow and the investor sentiment. So I'm sure that the government would take all of this into cognizance before they come up with something.
Okay. Pratip, I come to you. We have spent some bit of time on AI, but tell me a little from a VC firm perspective. What is the conversation like amongst the other VC firms? There is, of course, too much capital. Like you said, there's too much dry powder sitting on the sidelines waiting to be invested. So, what's really the challenges? Do you think the ball has shifted to the VCs now? The startup valuations have become more realistic? Are there enough interesting ideas out there? Because historically, private equity in India really has been the game where there are too much capital chasing too few companies. So, what do you think is the scenario right now?
No, for sure. The ecosystem has matured over the last 4, 5 years, and the depth of pool of ideas have also exponentially increased for sure, right? So from an opportunity landscape perspective, uh, it's a great time to be investing, right? On your point, how has the power equation shifted? Investors who have been, always focused or have been disciplined about entry valuations, uh, and it's the right time for them, right, to invest. And all investors, irrespective of their size, manage external third-party money in their fiduciary capacity, right? Given that background, obviously it makes sense for them, to enter at the right valuation so that the value appreciation of the investment happens over a period of time. So for sure, the power equation has shifted in favor of people who are willing to stick their neck out, issue a priced term sheet, for sure. What's also additionally has happened is, uh, you know, there have been investors in the ecosystem who were quite active over the last 2, 3 years, and they have suddenly gone quiet in terms of their ability to write newer checks, right? So if earlier a round of a certain company was getting filled up in a month or a couple of months at best, now those rounds are taking at least 6 to 8 to 9 months to get completed, because some of those investors are taking a lot more time in building up their conviction level on those business plan and business ideas, right? Which was earlier not the case, right? But as I said, good companies who are raising money at fair valuations will always attract capital. That's where things are today.
A VC's definition of a good company keeps changing, though.
That's right. It changes like the weather. That's how I would say.
When
But
Mehak,
but fundamentally, a good company is a good company, right?
so Mehak, I'm sure you'll agree with me here. I'm not sure Pratip will or not. When there's just too much capital, the VCs will tell the entrepreneur, you should burn. Because
Yes.
even in this sector, the winner will be the number one or the number two player. If that means you have to burn capital, please burn. And now, when the down cycles happen, the same VC will say that you have got to be sensible. You're going to have sort of more realistic burn rates. So, the VC definition of a good entrepreneur keeps changing. But I think let's move to the last stage in the last round of sort of.
So one comment on that. The no, I agree with you. So the VC's definition of what is good might change, but what is good, and irrespective of what does a VC think, in the end, it is not the VC's company. It is the entrepreneur's company, right? And the buck stops with the entrepreneur, right? So that's very important. And history has proven time and again, irrespective of all big, great businesses are built on limited amount of capital. People who have been very capital efficient. You take Google, you take Apple, you take Microsoft, you take Reliance, you take DMart, listed, unlisted, in any space, right? Until unless there are areas like space exploration, which Elon Musk is building through SpaceX, wherein even to reach a certain minimum viable scale or to prove efficacy of the platform, you need to raise tons of money. I think all good and great businesses, history has shown, has always been built on limited capital, right? So and the question is, in the end, as I said, the buck stops with the entrepreneur.
Yeah.
Right.
Yeah. Also, I think for the entrepreneur, they need to take a call on which way the wave is riding, where the tide is going, and when they need to, sort of burn the cash for expansion, when they need to tighten their purses. And I think, yeah, it's a whole lot of learning journey throughout their period of running the company as well. And I agree with Pratip when he says that the buck stops with them, and that's a fact. And they figure that out on their journey as well.
Okay.
Yeah, I always say it's like riding a tiger.
Yeah.
So you need to know whether you want to ride the tiger or not, because you
Yeah.
never know
Which way it's
he
going to
suddenly
go.
turns and eats you up. Yeah.
Yeah.
Yeah. So I think let's sort of get into the end of the conversation. I also want this conversation to now get a little more interesting. Okay, I want this to be an interesting conversation. Okay. Uh, from a regulatory perspective, Mehak, and I come to you, the mammoth sort of transformational act that happened, which was the data protection bill. And one can't really not have a lawyer not talk about it. What does it really mean in simple terms, for startups? Say startups in the e-commerce space. Would you consider data as an asset or a liability now? And do you think a transformational bill like that has repercussions for M&A, has repercussions for deal making? What would that be? And I'm not really sure if VCs have really taken note of the data protection bill very, very seriously. I do see some chatter amongst the legal fraternity, but I'm not seeing a lot of conversation from the investors so much. What really is your sense?
So Shrija, yeah, I mean, you're right. So just answering the second part of your question first, that there's not a lot of chatter around it as far as the industry is concerned, that the startup founders and the investors. I think that's also because the law in its current form doesn't have a regulator as yet. The data protection board is yet to be set up. The MOS for IT has announced recently that in the next 30 days, the data protection board is going to be set up and the rules are going to be notified. So I think once there's a regulator, once the rules are notified, things start moving as far as the processes are concerned. And slowly we start seeing notices being issued to companies. Probably the amount of seriousness is going to seep in at that point in time. And as far as the impact on the investors or the investments are concerned, of course there is going to be an impact, because the data protection bill compliance is going to add on to the cost of compliance for the companies. Also, in the way that the data inventory is maintained, in the way that the data is processed, the data is safeguarded, the disaster management plans as far as data protection are concerned, as to whether those are working or not, whether those are even suited for the particular sector of the company or not, whether the companies need to move beyond the basic ISO 27001 certifications and actually do something about their technical securities and setups, and also take some steps at the organizational level. All of these things are something that the companies would need to work on. And consequently, if they don't, and there are repercussions, which can be a lot under the current law, because the penalties can go up to 250 crores. And if there are those kind of repercussions, and if there are non-compliances, then of course that's going to be a roadblock as far as the due diligences are concerned. And this is going to be something that the investors would eventually be concerned about, if not now, then a few months later. And that's my sense on it, because this is something we can't ignore. The data protection bill is an asset for the individuals, because now it's turned into an act. But as far as the industry is concerned, it is definitely an added cost of compliance, which would have its own set of repercussions.
Okay, that's sort of well said. Okay, Pratip, I come to you now. Last sort of round of questioning. Really, from an Inflexor Ventures perspective, if you were to tell me three things now that we are sort of pretty much ending this calendar year, three things or three trends which kind of took you by surprise, what would those really be? It could be maybe an idea which you found revolutionary, which you're not seeing, or maybe some trend which you have not seen in your career, or maybe some LP conversation which took you aback. What would that really be? Yeah.
Quite a difficult question. But I would say the pace at which um so uh, some of us had at least seen it. The pace at which capital got dried up quickly, right? Um was quite unprecedented for quite a bit of entrepreneurs and managers, right? That's for sure, uh, you know, is something which was unprecedented. Just the way the rise was unprecedented, the fall is also unprecedented, and we have not yet seen the bottom. As I said, the next 4 to 8 quarters will be tough. So that for sure is one thing, right? 2008 was a different beast because only the financial services sector was impacted, and money dried up globally very quickly. Here, uh, the impact uh, on certain segments because of the end of the zero interest rate regime is more on the tech space, right? Uh, so that has been quite unprecedented, which hasn't been seen earlier. The second thing which also saw, I would say, which hasn't happened in the past 2 decades or thereabouts is today for the external LPs, right, overseas investors who give money to managers like us or who even directly invest, they have in the last 5 years or so have seen good amount of liquidity, listing of companies from the space in which the tech venture funds were investing, getting IPO'd and seeing some liquidity and cash back to them. And that has resulted in, obviously tons of money waiting on the sidelines, waiting to be deployed or waiting to get allocated. And what has further added to that fact is, because of the global geopolitical challenges with China and the rest of the world, today for allocating capital in the tech space, other than US and Israel, India is the only other alternate large viable market. So that's something which is quite unprecedented because it's the confluence of the ecosystem deepening and getting matured over the last 5, 7 years, exits happening, and fresh capital waiting to get allocated when valuations have corrected. So I would say uh, the coming decade will be a great decade for investing and for building great companies out of India. And it will also be the decade where the unstoppable force of technology will meet the regulatory Himalayas, right? Globally, it's happening. It's happening in Europe. It's happening in US, and it is bound to happen. Time has always said, okay, regulations are bound to come in. How some of the investors and entrepreneurs manage that regulatory landscape change will also determine how quickly can they scale, you know, how they could raise more capital. So that for sure will be the defining aspect of the upcoming next 5, 7, 10 years.
Okay, thanks for that, Pratik. So basically, Mehak and you're gonna be extremely busy for the next 10 years, essentially. Mehak,
We hope to.
We hope to. I think I don't mind that at all.
okay, great. So I think so one sort of last comment, and definitely on this very important LPGP relationship, we spent a lot of time talking about the founder and the investor relationship. And Pratik also said that Shrija, whatever happens, the buck stops with the founder. But let's also spend the last 5 minutes talking about the LPGP relationship, because all said and done, private equity is the business of the LPs, by the LPs, for the LPs, right? These are the people whose fiduciary money we are sort of handling from investors' perspective. And they're definitely, Mehak, in your day-to-day lives, these are the ultimate stakeholders that you deal with, right? So tell me a little about the LPGP relationship, especially post-COVID scenario. I see more disappointments than happiness coming from that sector. I mean, tell me if I'm being right or wrong in my assessment, because as sort of Pratik mentioned, maybe some liquidity happened 2, 3 years back, but of late, if you speak to a few LPs and if you go to some reports, there's disappointment, especially when it comes to some of the Indian funds. Yeah.
Shrija, I do partially agree with you. I mean, of course, there are, so as to say, with how some of the recent startup issues have panned out. and especially in the regulatory domain, and there have been some litigation around the founders as well. So those issues combined with a lot of regulatory discomfort that the investors have seen with their investments. I think all of that has sort of dampened their spirits. And, this is something that I personally feel is, again, a phase, because whatever has happened recently, and there have been a few examples of certain issues that have come up, whether that's in the regulatory space or with the founders, I personally feel that one can take the learning from these issues and move on. And of course, better the practices, better the documents, better the due diligences, and also better the founder LP communications, and take the best learning out of this and move on, because there's not much that one can do with whatever has happened. But the good thing that has come out of this is that the LPs and the investors have voiced out their concerns as a fraternity, and I think the founders have also reciprocated, and they've shown their willingness to sort of work on those concerns, whether that's in terms of having independent experts, so whether that's setting up independent committees, whether that's getting more experienced auditors and compliance consultants, so on and so forth. And I believe this is going to be the way to go, because ultimately there has to be complete sync and collaboration amongst these two parties if things need to move smoothly in motion.
Okay. Pradeep, I think it's definitely important to get your view on the evolving LPGP relationship. What do you think? Which direction is it treading? I mean, Mehak did point out that there have been disappointments in terms of course, what the press is saying and what has unraveled in the past with very large companies have actually unraveled, and like how. So, what do you think is the LPGP conversation and how is it sort of shaping up?
So for sure, and for right reasons, the LPs have all the right to ask the questions and get into the nitty-gritties of why and how it has happened, and to look into it, okay, how this shouldn't be repeated, right? Because in the end, as I have said in the past, um, any GP manages the capital in its fiduciary capacity, and they are the custodian of that capital. So in the end, mm, when the company is nascent, the responsibility is also with the investors. Equal responsibility is also with the investors, besides the entrepreneur, to ensure there are right checks, balances, processes, external, internal audits being done, governing councils, financial controls and systems being put in place, so that when the company scales up and is process intensive and transaction intensive, then those processes will come to safeguard, uh, the rights and wrongs. Right? So I believe the conversations with of such GPs with their LPs will be around these aspects. Okay, what has been the gaps in assessment and how they could be plugged in. And in the end, this is nothing new, right? Because the industry is quite old, both overseas and in India, it may be 2, 3 decades old. But there is enough and more evidence of what needs to be done, right? The question is, uh, it should have been done, right? So there is enough knowledge and understanding around, through legal experts, through chartered accounting firms, on what needs to be done, right? The question is on implementation, and there I would say the buck stops both with the investors and the entrepreneur, not just the entrepreneur.
That's a good one. Yeah. And I agree with Pratip on that, because yes, I mean, when such incidents happen and things get full blown and they come out in the public domain, I think that serves as a lesson as well as a starting point. And yes, the people know what is to be done, but putting it into motion is, the difficult bit. But the sooner that gets done, I think the better it is going to be for the industry.
Yeah, and I think the responsibility, the shared one,
Yeah.
the founder and as well as the VC. If the VC is on the board of a company, I mean, you can't just get away from that responsibility. Um, Thank you, Mehak, and thank you, Pratip, for joining us on this episode of the RegTech Edge. Till time I see you next, goodbye and good luck. We spoke on quite a few topics: founder-investor relationship, the M&A pipeline, how the due diligence will evolve, data protection laws, and so on. And I hope our listeners enjoyed the conversation. And till time I see you next, goodbye and good luck. Thank you so much. Thank you. Bye-bye.
Thank you. Bye.
Thank you so much.
Thank
Thank you,
you so
Mehak.
much.
Thank you, Srija.
Bye.
Thank you,
Have a
Shuja.
nice
Thank
day.
you, Pradeep. Thank you.